Hey guys, Fredpasselli here, CPA based out of South Florida. Welcome back to the channel if you've been here before. If it's your first time, welcome. So today I want to talk about a topic that a lot of accounting students tend to struggle with when they first get started, and that topic is going to be adjusting journal entries. So adjusting journal entries are going to be split into two main types. You're going to have deferral entries. So that'll be deferred revenue and deferred expenses. And then you're going to have accrual entries. You're going to have accrued expenses and accrued revenues. So just to give some background knowledge, this is all going to be under accrual accounting, which is the accepted accounting under GAAP, which is general accepted accounting principles. So these are adjusting entries that are basically going to ensure you're recording revenue when it's earned, and you're expensing expenses when it's incurred, not when cash payment is received or spent. So the first one I want to talk about is going to be the deferrals. So the main deferrals we're going to cover are going to be deferred expenses and deferred revenue. So we'll start with deferred expenses now. Deferred expenses, what I really want to touch on here, those are also going to be called in a lot of cases prepaid expenses. So what these are is when you might purchase an item all at once, such as insurance, rent, or supplies. You're going to essentially maybe buy insurance or supplies for a year all up front and pay for it right then and there. So in that initial entry, you're going to debit an account. Let's go with insurance. We'll use insurance as the example. So in that initial entry, you're going to debit an account called prepaid insurance, which is an asset account, and you are going to credit an account called cash. So you're basically going to decrease your cash account because you spent it. Now, if you notice, you're not expensing the insurance under the deferral expense, because remember, you have to incur or have usage of the expense to record it or recognize it. So what we're going to do now is each month, as we use up that insurance, we're going to expense the insurance. So the adjusting journal entry, the deferred expense, is going to be a debit to an account called insurance expense. And now you're going to credit that account prepaid insurance. So I'll give you the scenario. Let's say Passelli Accounting Services, which is my company, we prepaid insurance for $12,000 for the year. We paid it all on January 1st. So we're going to debit the prepaid insurance account for $12,000 and credit cash for $12,000. That is the initial purchase of the prepaid, the insurance in this case. Now at the end of month one, the end of January, we need to now record the usage of that insurance that occurred. So what we're going to do is first we're going to have $12,000. We're going to record this monthly, so we need to solve for how much we're recording. So it's going to be 12,000 divided by 12 would equal 1,000 a month. Now the first entry is going to be a debit to an account called insurance expense and a credit to the prepaid insurance. Because remember, we're crediting that asset prepaid insurance because we are now using it up. So the adjusting journal entry is a debit to insurance expense and a credit to prepaid insurance. Remember, for deferrals and accruals, all the actual adjusting journal entries themselves involve one income statement account and one balance sheet statement account. So the income statement account in that adjusting journal entry I just spoke about would be insurance expense. And the balance sheet account in that journal entry I just spoke about will be the prepaid insurance. So that is an example of a prepaid. Another example of deferral expenses would be depreciation journal entries. So we're not going to go too much into what depreciation is in this video because that's basically can have a video of its own. But depreciation is essentially the usage of an asset over time and you absorbing that cost. So monthly you would depreciate an asset by the amount of depreciation expense you would calculate based off of the cost and the salvage value and the useful life. So real quickly, I'll tell you the formula to calculate depreciation. So it's going to be cost or purchase price of the asset minus the salvage value. Salvage value essentially is going to be what you think you could sell that asset for one day when you're done using the asset. So if you're going to sell a car, if you bought a car for $20,000 and in 5 years you think you could sell it for $5,000, the salvage value would be $5,000. So once again, the formula for depreciation is cost minus salvage value divided by useful life. Useful life, all that is essentially how long the asset is going to last. So we can say in our example, we purchased the car for $15,000. We believe it's going to have a salvage value of $3,000 and it's going to last for 5 years. So the way we would do that is we would take $15,000, the cost, minus the salvage value of $3,000. That would get us to $12,000, and then we would divide $12,000 by 5, and then we would get our depreciation expense per year. If we want to solve for the monthly amount, we would simply take that annual depreciation and then divide it by 12 again. So in this case, let's say the depreciation expense per year is $3,000. We would divide that by 12, and then we would get a monthly depreciation amount. Now, to record the depreciation on your books under this straight line method is what we're learning. You're going to debit an account called depreciation expense. This is a normal expense account. So you're going to debit an account called depreciation expense for the amount of depreciation you calculated, and then you are going to credit a contra asset called accumulated depreciation. So contra assets are relatively a new account for students at this point. It essentially all it is it's an account that has a credit balance that is going to offset an asset account. So normally the way this is presented on a financial statement, it'll be presented on the balance sheet and it would net the value of the assets on the balance sheet. So let's say the cost of the asset was $5,000, the accumulated depreciation for that asset was $500. You would see a net value on the books of $4,500. So once again, the journal entry to record the depreciation that we just calculated is going to be a debit to depreciation expense and a credit to accumulated depreciation. Remember, accumulated depreciation is a contra asset account that has a normal credit balance, and essentially that is going to be shown on the balance sheet. Okay. So those are the two main type of deferred expenses I want to talk about. Now I'm going to go quickly. We're going to do a quick overview of deferred revenue. So deferred revenue is going to be when essentially the best example I can give you is when you receive payment up front for work you have not performed yet, so you cannot recognize the revenue yet. Remember, under GAAP, you cannot recognize revenue until the job is complete, the performance obligation is complete, or goods are delivered. So let's say the example I like to normally give students is, let's say you are a contractor, you are a building contractor, and you get paid $25,000 up front to do a job, but you have not done that job yet. You won't do that job for another 6 months. So the initial entry to record that cash you received, it is not going to go to a revenue account. This is the actual entry now. You are going to debit an account called cash. So that's you receiving the money. So you want to increase cash because you're receiving cash. And now you are going to credit an account called unearned revenue or deferred revenue. They can be used interchangeably. So the recording of a deferred revenue is going to be a debit to cash and a credit to unearned revenue. This is showing that you have received cash, but you have not completed the work yet. Unearned revenue or deferred revenue is actually a liability account. So think about it this way. It's a liability account because you owe them work. The liability is the work you owe them. So the example is you receive $20,000 for a job you're going to complete in a month. So to record that initial economic transaction, we are going to debit cash for $20,000, credit unearned revenue for $20,000. Now, for the adjusting journal entry, let's say in 1 month, now you complete that job. So now we are going to recognize the revenue itself. It's very simple. We're going to debit unearned revenue because we want to get rid of that now, because now we don't owe them. We did the job. And we are going to credit revenue because we're recognizing the revenue. The performance obligation has been complete and the work is done. So remember, we're debiting unearned revenue because that account is a liability and we need to remove it from our books because we no longer owe them the work. So we're going to debit unearned revenue for $20,000 and credit service revenue or contracting revenue for $20,000. And that will be a good example of a deferred revenue. Now, so actually in this video, we're just really going to go over deferrals. That was deferred expenses and deferred revenue. I'm going to do another example on accruals in the future. So definitely stay tuned, look out for that. And if you have any questions, don't hesitate to ask in the comment section below. Thank you.